Bismillahirrahmanirrahim. Assalamu alaikum warahmatullah. In this video, I'm going to discuss the material that we will be covering in chapter 12, which focus mainly on trading strategies involving options. So I will leave you with this quote. I found this quote inspiring. A good trader with a bad model can beat a bad trader with a good model, and this is very true because it's not about the model that you are using, it's about how you are using it or how you are trading. That makes a difference. Now, in this chapter, we will be discussing four main different categories of trading strategies that involves options. The first one is called the principal protected note. It mainly involves investing in a bond plus an option, and usually this option is a call option. The second category of trading strategies involves investing in an option and its underlying stock. Since starting from chapter 11, we focused on stock options, so we will continue this practice, and we will focus on options where the underlying asset is stocks. The third type of strategy is called spreads, and it is basically two or more options of the same type, so two or more calls or two or more puts. The last type is called combinations, and combinations involves two or more options of different types. So for example, a call option and a put option, two calls, one puts, and so on. Now it's important for us to remember what we learned in chapter 10, which was mainly how to determine the profit equation and the profit diagram or profit graph for the strategy that we will be considering. So we will look now or revisit quickly the profit equation for buying or selling stocks or calls or puts. In addition, in some strategies, we will be looking at the effect of choosing different exercise prices, because the choice of the exercise price or the strike price also will have an effect on when the strategy will be profitable and when it will not. And also we will be looking at the effect of keeping the strategy or holding the strategy for a certain period. So we will see if we close out the option position early versus closing or holding the option until its expiration. Again, some of the terminologies that we already have seen in chapter 11, which is basically the current call price, which we will refer to by C, and current put price, we will refer to it by P. We learned in chapter 11 that capital C is for American and small c is for European. Pretty much we will keep up with the same standard. So although that we will focus mainly on European options in our analysis in this chapter. S0 is the current stock price, ST is the stock price at expiration, T is the time to expiration, and K is the exercise price or the strike price. And the Greek letter P or pi is the profit from the strategy. What we need to keep an eye on is the number of calls or puts or stocks. So N is the number of calls, NC, NP is the number of puts, and NS is the number of shares. Now, if we used a positive value for n, it means that we are buying the instrument, or we are taking a long position in that instrument. If the position was negative, so the number of stocks or the number of calls or the number of puts was negative, then it implies that we are going short. So we are selling or we are taking a short position. Right. Now, let's look at the profit equation for some of the strategies, so some of the instruments. So for call options that are kept until the expiration, the profit is equal to the number of call options times the payoff of the option that we will be realizing minus the premium of the option. Now, if we took a long position in one call, then NC will equal to 1. This implies that the profit is equal to basically the payoff that we will receive minus the premium we paid. Since I took a long position in a call option, I'm going to pay the premium and I'm going to receive the payoff. If you remember the chart or the graph I showed you for the two parties, one party is paying the premium and receiving the payoff, and the other party is receiving the premium and paying the payoff. For the party that took a short position in a call option, or the seller of the call option, or the writer of the call option, we will consider NC to be negative, so it will be -1, which implies that the profit will be, so since this is equal to -1 times what's inside the bracket, we will get negative of the payoff plus the premium we received. Why? Because the seller is going to pay the payoff, right, and to receive the premium. So since he is paying the payoff, it will have a negative value, and since he is receiving the premium, it will have a positive value. If we want to examine the profit equation for puts that are held until expiration, well, basically the profit is also equal to the number of put options times the payoff minus the premium. Now, for a party who will take a long position, or buyer of the put option, the profit will be basically the payoff that he will receive minus the premium he paid. For the seller of a put option, since he took a short position, or the writer of the put option took a short position, which means the number of puts will be negative, then the profit will be basically the payoff he will pay and the premium he received. Now, if we want to apply the same thing or the same concept on stocks, which is much more intuitive, basically the profit is the price at which you bought the stock minus the price at which you sold the stock. Now, if you are a buyer of one call option, which means N will be positive, then the profit is basically the price when you sell the stock minus the price you paid to own the stock or to obtain the stock. For the short seller of one share, well, N will be negative, and this implies that when you enter into the stock at the first time, you will receive cash, right? Because you shorted the stock. And when you cover your short position, you will pay to buy the stock. So you will pay for the stock, and that will have a negative effect on your profit. So you notice that it's the opposite of buying one share. Now, this part is quite intuitive. If you want to skip this part, you can do that. Now, what we are examining here, something very basic, which is buying, what will be the profit from buying one stock. So the profit equation is basically, if I took a long in the stock, it is the number of stocks times ST minus S0. So if we assume that S0 is 125.94 for a stock, for a fictional company called DCRB, and we will notice that, just a second. So in this diagram, we observe that there is a positive relationship between the underlying stock price and the profit you make, and which is logical. If you bought the stock at 125.94 and the price when you sell it is 165, then you make a profit. If you sold it for 95, then you are going to make a loss. So this is something that is basic and intuitive. Now, taking a short position in the stock is what sometimes students mix up a little bit with. Now, when you take a short position, it means that you are going to sell the stock. You will borrow the stock from someone. You will sell it for 125.94, which means you will receive a cash. You will make a profit. You will make a profit basically if the price dropped. Why? Because then you will buy the stock when the price goes down. For example, let's say the price went to 95. So you will buy the stock, you will return the stock to the party who will lend it to you, and you will keep the profit in your pocket. Now, if the price went up, then and you might be forced to buy the stock because an exposure that the lender of the stock has, which is your inability to return the stock you borrowed. So if you borrowed the stock from a financial institution, they might force you after, if the price of the stock went up to a certain level, they will force you to buy the stock and return it back to them. So let's say the price went to 55, you will buy the stock at 155. You sold it or you received only 125, so you will approximately lose around $30. So for a short position, it will only be profitable if you are expecting the price will go down. The long position is the opposite. It will be profitable if you believe the price of the stock will go up. Now, before we leave the stock transactions, let's just remind ourselves what's the maximum profit and what's the minimum profit or the maximum loss. So for the stock, the maximum profit is unlimited. There is no limitation on by how much the stock price can increase to. So at least theoretically, the maximum profit is infinity. The maximum loss is when the price of the stock drops to zero, in which case you will lose the price you paid for buying the stock, which is 125.94. So that's the maximum loss that you can incur. How about the short in the stock? Now, the maximum profit you will achieve when the price of the stock drops to zero, in which case you received 125.94. However, you will not have to buy the stock to cover your position, so you will keep the 125.94 in your pocket. What is the minimum profit or the maximum loss? Is infinity. Now, as we saw here, as the price increases, your loss will increase, and since there is no limitation on by how much the price of the stock can increase, then also there will be no limitation on your loss. So this shows you that a short position, it's not a short position in a stock, it's not a safe strategy, it's a risky strategy. However, if you do it in a proper way and your expectations about the movement in the stock price turns to be true, you will also make a profit in the down movement of the stock market. Next, we turn to call option transactions, which we also covered in chapter 10. So here it's a quick review. Again, if you are comfortable with positions, you can skip to the next part. So for the case of taking a long in a call or buying a call option, the profit equation is basically the payoff you will receive minus the premium you paid times the number of options you enter into. We learned in chapter 10 that the profit is equal to ST minus K minus C if the call option was in the money, which means that you will sell it for ST. You will buy the stock at the strike price and you pay the premium. So that basically will be your profit. Now, if the option was out of the money, which means you will not exercise the call option, then your loss will be basically the premium you pay. If you want to revisit how the profit diagram looks like for a call option, and here we're looking at a call option on DCRB stock that will expire in June with a strike price 125, and that has a cost of 13.5, so the premium is 13.5. We can see that for a call option position, the break-even point will be basically the strike price plus the premium you paid. So when the price of the underlying stock reaches 138.5, you will break even. So you either profited or nor did you lose any cash in this investment. Now, is there a maximum profit for the long call? No, since the profit increases as the stock price increases, so the profit is, at least from a theoretical point of view, has a maximum of infinity. Is there a maximum loss? Yes. The maximum loss is basically the premium you paid. And if we engaged in options that are traded in organized exchanges, so let's assume that the option on DCRB stock is traded in the Chicago Board Option Exchange, then every option contract includes 100 options. So we have to pay 100 times 13.50 to enter into the option contract. So the maximum loss is when the option expire out of the money, which is basically the premium we have paid. Now, here we want to examine the effect of choosing different strike prices. Now, the basic formula that will guide us whenever we are examining the effect of different exercise prices is, first, the intrinsic value or the payoff is equal to the maximum between S minus K or 0. So ST, since we are looking at the expiration date, what is the behavior of the underlying stock? And we know that the option price price, the option price, or the option premium, is equal to the intrinsic value plus the time value. Now, if we increase the strike price, what will happen to the intrinsic value? The intrinsic value will drop. So if we increase K, the intrinsic value will decrease. And if the intrinsic value decreased, what will happen to the option premium, or the call option premium? It will also decrease. So what are we seeing is that the call option with strike price 130 has the lowest loss. So if the option ended out of the money, our loss will be lower than the call option with the strike price 125 and 120. Now, is this without any expense? No. If I bought the option with the strike price 120, then I will be able to exercise the call option at a price level lower than the call option with the strike price 130. So if the price of the stock was increasing but did not reach 130, I can exercise the call option with 120, but I cannot exercise the option with, or it doesn't make sense to exercise the call option with the strike price 130. This fact makes me realize a profit or realize a payoff at a lower level compared to the 130. That's why for any given level of the stock price, always the option with the lowest strike price has a highest profit. So what's the, again, to recap, what's the effect of the different strike prices? First, it has two effects. One is the effect on the losses you will incur in investing in the call option, which will be lower if the strike price is high, and will be highest if the strike price is the lowest. Why? Because, as we said, there is a negative relationship between the strike price and the intrinsic value and the option premium. So the option with the strike price 120 has a premium higher than the option with a strike price 130. This fact makes us lose more if the options were out of the money. For example, on the expiration date, the stock price was 105. All three options are out of the money, but I will lose more in the option with the strike price 120 because I paid a higher premium for that option. I will lose, my loss will be the lowest for the strike price 130 because I paid a lower premium for that call option. Now, next we will turn to examining the effect of holding the option for different holding periods. Now, if I bought a call option and I waited until time, so what do we have here? We have 3 points in time. Let's draw the timeline so it will be clearer. So let's say we have here time t1, time t2, and time t. Time t is when the option expires. Time t2 is a period before time t, but longer than time t1. And time t1 means I will buy the call option, and at time t1 I will sell the call option. So I will exit, I will take an offsetting position. The same thing will happen at time t2. If I waited until time t2 and I decided to exit from the call option, I will take an offsetting position, which means I'm going to sell the call option. Now, why do we observe that at any given level of the underlying stock price, I'm always going to realize a higher profit for the shorter holding period? Now, this comes from the following fact. We learned in chapter 10 that we can decompose the option price into two components. One is the intrinsic value and one is the time value. Now again, we can decompose it into more than two factors, but for the sake of this course, since it's an introduction, we will just assume that we will only decompose the option price into these two components. Now, if we assume that the intrinsic value is going to be fixed, since we want to examine only the effect of the period, assume that the intrinsic value will not change. So let's, for example, here, if we examine the effect of keeping the option until time t1 or time t2 or until the expiration of the option, to fix their intrinsic value. And what do you notice? We learned in chapter 10 that there is a decrease in the time value as the time passes. So when the option is initiated, initially the value has a high value. As we approach the time to expiration, the time value component will decrease until the case when we reach the expiration date, the time value will equal to 0. Now, what does this mean? It means that if we exit when at time t1, what is the level of the time value? It's high, right? When we exit, are we going to buy the call option or we are going to sell the call option? Well, initially, I took a long position in the call option, which means if I want to take an offsetting position, I will sell or take a short position in the call option. Okay, when I take a short position in the call option, I'm going to receive these components or I'm going to pay these components. Well, if I'm taking a short, it means I'm going to receive them. When I receive the time value part, assuming that intrinsic value did not change, receive a high part of the time value. That's why the profit will be the highest when we exit at time t1, because I retrieved most or a big part of the time value I paid initially. If we waited until time t2, the time value is not 0, but it's lower than time value that I will realize at time t1. Right? You can observe here that the time value at time t2 is lower than the time value at time t1, but still it's higher than at time t. At time t 0. That's why we will observe that always keeping the call option for a holding period, assuming that the intrinsic value did not change, we will achieve a higher profit. Now, is that what will happen in reality? Well, in reality, the intrinsic value will not stay constant. It changes because the stock changes. Now, if the change in the stock price will offset the decay in the time value, then it doesn't mean that waiting until the maturity you will always realize a lower profit. That here, it's for the sake of analysis, assuming that the intrinsic value did not change, which holding period will result in a higher profit. It's always time t1, and let's find ourselves that time t1 is smaller than 2, which is smaller than time. Okay, now let's examine the case of taking a short position in a call option or writing a call option. As we saw earlier, the profit creation will be the payoff minus the payoff plus the premium we will receive. So if the option was in money, then my profit will be the payoff I'm going to pay plus the premium I received. So I will pay minus SC plus K, right? And I will receive the premium. If the option expires in the money, out of the money, then the call will not be exercised, and I will keep the premium in my pocket. Again, this is what chapter 10, the diagram, the profit diagram for a short call. As here, the maximum loss in a short call is infinity, which means this position, a short call, is the most risky position among the 4 positions in investing in a call in options. What is the break-even point for writing the call? Well, since I am paying the payoff and I received the premium, again, the break-even point will be the exercise price plus the premium I received. Why? Because I will always pay the difference between the price and the strike price and receive the premium. So at 138.50, my position will break even. So I will either lose nor I'm going to gain. If the option expired out of the money, then I will keep the premium. And since we're dealing with options that are traded in organized exchanges, we cannot invest or enter into a single option. We have to enter into a bundle or a package of options, which is called an option contract. Involves 100 options. So if I short one call option contract, I will see it is similar to shorting 100 call options, which means I will receive the premium times 100. Now, the maximum profit for investing in a short call, well, it's the premium you received. If we quickly want to examine the effect of different exercise prices, or different strike prices, we will notice that the option with the lowest strike price will always result in the highest gain. And this is also logical because I'm the one who's receiving the premium. So if I short an option with a strike price 120, I receive highest premium among the other 2 options. And if the option expired out of the money, I'm going to keep the option in my pocket. But if the option, if the underlying price was in an increasing trend, then I will, the counterparty will exercise at any level above 120, which makes realize a loss or pay a payoff earlier compared to, or at a lower price levels compared to 2 options with strike price 125 and 130. That's why the investing a call option with the lowest strike price will result in a highest gain, but also in the highest loss. Now, if we want to examine keeping the short call for different holding periods, we will follow the same analysis. We will look at what is the component at each holding period and how this is going to affect our profit. If we revisit this chart here, now we learned that at time t1 the time value will be the highest. Okay, but why I'm going to realize the maximum loss compared to holding period time t2 or waiting until the expiration of the option? It goes back to the fact that what position did I take when I entered into the option? Did I take a long or did I take a short? Did I receive the premium or did I pay the premium? Well, when I entered into the option, since I entered into a short position, I received the premium, which means I'm going to exit from this position. If I want to take an offsetting position, I'm going to buy. And when I'm going to buy, where I'm going to pay more time value, assuming again intrinsic value is fixed, assuming the stock price is constant, it's not going to change. If I exit at time, I'm going to buy the call, which means I'm going to pay for the premium, which means I'm going to pay more for the time value. Until time t2, no, I'm going to pay less for the time value, but still it's not zero. If I wait until the time to expiration, until the option's expiration, I will not pay anything for the time value. If there is payment, it will be only for the intrinsic value. That is why keeping the option until the expiration will result in the highest profit, because I will not pay for the time value. But if I exit at time t2, the profit will be higher compared to time t1, but less than waiting until the and I am offsetting, I'm taking an offsetting position, I am paying for the time value. If I exit too early, then I'm paying a large part of the time value I have received, which will result in the highest loss again for every single stock, every single level of the stock price. Again, this analysis, the intrinsic value is constant, it's not changing. Let's look at the put option transactions. The profit, as we saw earlier, it's basically the number of put options times the payoff I'm to receive minus the payoff, the premium I paid. So if the option is in the money, which means ST is lower than the strike price, then my profit will be basically the strike price minus the bank stock price minus the premium I received. If the option expired out of the money, which means I will not exercise the put option, my profit will be basically, or my loss will be basically the premium. So let's examine the put option on stock DR, which expires in June and has a strike price 155 and a premium of 11.50. Now, in strategy, there will be a maximum profit, which is when the price drops to zero, right? So it will basically amount the difference between the amount I paid for the premium and the amount I'm going to receive when I exercise the so if I exercised, I will receive 125 minus 0, assuming that the price went to 0, and I paid 7.50. So the maximum is 11,350. Why 11,350? Because we are dealing with options that are traded in organized exchanges, which means we need to enter into 100 put options. Now, what's the break-even point? It's basically the strike price minus the premium I paid. Why the strike price minus the premium? Because in a put option, either I sell, and when I sell, I receive the strike price. So it's the strike price, the amount I'm going to receive minus the amount paid, that will give me the break point. The maximum loss in a put option is basically the amount I paid for the premium. Since I entered 100 put options, so my maximum loss will be 1,150. What is the effect of choosing different strike prices? In the case of a put option, we have to look at the intrinsic value for a put option. So the intrinsic value is basically the maximum between K minus and 0. And we remember that the option or option price is equal to the intrinsic value plus the time value, which means if we increased strike price, what will happen to the intrinsic value? It will increase. Intrinsic value here. And if the assuming the time value is not going to change, the premium for the option will also increase. What does this mean? It means an option with the highest strike price will cost me more than the option with the lowest strike price. Is that what we are seeing here? Well, yes. So look at here. The option with the strike price 130 costs more, which means if the options expired out of the money, my loss will be when the underlying when the strike price is 130, the strike price, because for the strike price 130 it has the highest premium. So since the option expired out of the money, I paid the premium, I have to receive any cash, so that will be my maximum loss. However, if the price went down, excuse me, so if it went down, I'm not able to see the point. If the price went down, okay, so as the price goes down, we'll be able to exercise the option with the highest strike price earlier compared to other options with the lower, and this will result in realizing a payoff earlier compared to the options. That's why we see here that the put option with the highest strike price has the highest profit. The put option with the lowest strike price costs us less, however, will always achieve a lower profit compared to the other strike prices. What's the effect of keeping the put option for different holding periods, as we did in the case second. As we did in the case for the call option, the same idea applies here. We need to look at the effect of keeping the option for different holding periods. Time t, the longest, the time to expiration. Time t2 is in between time t1 and time t. Again, time t1 is lower than time t2, which is lower than time t. Okay, why we are realizing highest profit for any level of the underlying stock or level of the intrinsic value when we exit T1? Again, it goes back to the fact that did we pay for the premium or did we receive the premium? Since I took a long position, I bought the put option, I paid the premium. Okay, when I exit at time T1, I'm going to take an offsetting position, which is taking a short position. I will sell the put option. When I sell the put option, I'm going to receive the premium. Now, the intrinsic value did not change. The time value will be the highest when I exit at time t. As we approach the time to expiration, the time value becomes smaller until we reach the date on which the time value will be equal to 0. So if I waited until the expiration, my profit will be the lowest because I'm not going to be able to retrieve any of the time value that I paid when I entered into the long. So the time value is 0, forget it. I will not receive anything related to the time value. Now, I'm going to receive only the intrinsic value. But if I exit at time t2, for example, now I will be able to get back some of the time value that I paid in addition to the intrinsic value. Now, clearly, since the analysis is the same, we should not waste much time on the short position on option. The equation or the equation is basically the opposite of the long position. So if the option was out of what's in which ST is lower than K, then my profit will be minus K because I am going to pay for the pay I'm going to pay for the strike price. Since the counterparty has the right to sell, he will receive the strike price. I will pay the strike price. And if I receive the stock, I want to keep it in my position, so I will sell it in the market for ST, and I received the premium. If the option expired the money, in which case ST is greater than K, I will receive the premium. The option will not be high, so I will keep the premium in my pocket. Now, the maximum profit for this position is the premium that we received, and the maximum loss when the price of the stock goes to 0, in which case I will pay the strike price. I will to sell the stock, so I lost the value of the stock. So my maximum loss will be 11,350. Now, examining the effect of different strike prices and different holding period is not different from taking a short position in the call option. So we can skip this part and we should turn to the first strategies that we will be covering in this chapter, which is a bond plus an option.